Chairman, members of the committee, my name is Dale Steager. I'm with Spillman Thompson Battle here in Charleston. And I thought I would begin my presentation this morning by talking a little bit about what is valuation, what does the Constitution require, a little bit about the methods of valuation, as kind of a prelude for the rest of the discussion this morning. We know that the Constitution says that the value of property is to be ascertained as directed by law. And there are a number of laws on the books here in West Virginia that talk about valuing different types of property. We also know that property is to be assessed at 60% of its market value. That too is in the Constitution. And we know that the terms value, market value, fair market value, true and actual value, and appraised value basically have the same meaning. And generally they mean that they are the price at or for which a particular item of property will be sold by a willing seller to a willing buyer, with everybody having the same knowledge about the particular property. The Constitution requires that laws providing for the determination of value must provide for consideration of trends in market value over a period of years, the location of the property, and such other factors and methods as the legislature may prescribe. This is illustrated by the definition of value in West Virginia Code section 11-1A-3, subsection I. I talk about that section on page 3 of my handout. Some of the sections of the code go into considerable detail about these valuation considerations, but many times that's left to regulations that the tax commissioner has promulgated. And in my paper, I point out in particular the tax commissioner's legislative rule pertaining to the appraisal of commercial and industrial real property. Now, two exceptions to the general rule that I just mentioned about property being valued for property tax purposes at its market value are farm property and managed timberland. Farm property is to be valued by giving consideration to the fair and reasonable value of the property for farming purposes, not its highest and best use value. And this is typically by looking at the rental income that the farmland can produce. And that's provided for in the Constitution in Article 10, Section 1B, which was added to the Constitution in 1982. Managed timberland, on the other hand, can be completely exempted from property taxes. And Michael Carl will talk more about managed timberland in a little bit. And that, the authority to completely exempt managed timberland is found in Article 6, Section 53 of the Constitution, which well predates the 1982 property tax amendment. Now, county commissions sit as boards of equalization review in February of each year, and they're charged with hearing protests over assessed values, and at the end of their session in February, making sure that the property values are equalized in their counties. County assessors don't assess all property in the state. County assessors assess the property that they're charged with valuing, such as residential property, commercial, real and personal property. They determine the assessed value of properties that are valued by the tax commissioner, such as industrial properties and natural resource properties. But county assessors do not determine the assessed value of public utility property. Public utility property is valued by the state Board of Public Works, and the values of public utility property do not appear in the land and personal property books of maintained by the county assessors. The values of public utility property are maintained in a book kept for that purpose by the state auditor. Now, while county commissions are told in section 11-324 that they are to make sure that the property is equalized, assessed values are equalized in their county, I'm not sure exactly what they look at to make that kind of a determination, because I'm not aware of any statute that the legislature has enacted or any rule that the tax commissioner has put together, or any, if you will, public guidance that tells assessors how to do that. So equalization, it becomes in my mind an issue. Now, we know that the tax commissioner annually goes through and does a sales ratio study of properties basically throughout the state. But this sales ratio study is an after-the-fact document. For example, in 2014, the sales ratio study was completed in December of 2014. Tax tickets had been mailed preceding July 15th. And in some years, the sales ratio study actually is published much later into the next year. The point I'm making here is that the tax commissioner's ratio study is not out in time for assessed values, to the extent that they are not equalized throughout the state, for assessed values to be adjusted in time for issuance of the tax tickets. We also know that there's no equalization study made of personal property in the state. I'm not aware of any equalization study that's made of public utility property in the state. And finally, I'm not aware of an equalization study that looks at all the property that's in the state to determine that it's equal and uniform throughout the state, which is what the Constitution requires. So I think that's a weakness in the system. Now, in terms of how property is valued, generally there's three accepted approaches to valuation. There's others, but the three general methods are the cost approach, the income approach, and the market approach. Generally, in the cost approach, you determine what would be the, if you will, the replacement value for the particular property, and then you apply appropriate depreciation to come up with the current value as of the assessment date for that particular property. The income looks at the ability of the income-producing property to generate income, and then that is translated into an appraised value. The market approach looks at what are the properties they're selling for in the area. Now, when possible, assessors and the tax commissioner, for that matter, are supposed to use more than one method to determine the appraised value of property. As a practical matter, for various reasons, sometimes they only use one method, but the reason for wanting to use more than one method is the two methods have to be correlated. In other words, the results determined under each method needs to be correlated. And when determining the final value for the particular property, so when you're using two methods of valuation or three, it kind of operates as a check and balance to make sure that the value determined is a reasonable estimate of the appraised value of the particular property. The tax commissioner's regulations for appraising commercial and industrial properties gives wide discretion to both the tax commissioners, people, and county assessors to use the most appropriate method to value a particular property that they determine to be appropriate in the situation. Now, in terms of residential property issues, again, it's the market value standard that's used there. And assessors generally value real estate using an integrated assessment system that's supplied by the state property tax division. And under this system, raw value land and structures are separately valued. And what happens is the assessor enters data concerning comparable sales, information collected by field appraisers concerning the location of the property, the condition of the property, size of the property, how many rooms the house might have, and so on and so forth. And all this stuff is put into this IAS computer system, and the computer system is used to generate the appraised values for residential property. In my handout material is actually a copy of the Tax Commissioner's Administrative Notice 2015-15 that discusses use of the IAS system. Obviously, the weakness of this particular system is the accuracy of the data, the completeness of the data, and whether it's current or not. And we know that when the legislature mandated the statewide equalization survey a couple of years ago, that one of the deficiencies that were found in some offices of assessors was that their data entry wasn't where it ought to be with respect to the information that needed to go into this IAS system for their particular county. And of course, once the information was updated, additional information was added, sometimes this caused assessed values to increase dramatically, resulting in some members of the Senate and some members of the House actually introducing legislation that would put a limit on the amount of by which an assessment could increase when the increase in the assessment was due to a reappraisal and was not due to new construction. Interestingly, while residential property is valued using this IAS system and it's looking at essentially market comparables and other data, we have a section of the West Virginia Code that says that owner-occupied residential property is to be valued by giving consideration to the fair and reasonable amount of income the property might earn under normal conditions in the area area where it's located if the property were rented. Well, that certainly isn't the approach that is being used in the IAS system. The primary issue when it comes down to the valuation of commercial property is how should income-producing commercial property be valued for property tax purposes. Again, the typical way that assessors value this property is to determine replacement cost and then to reduce replacement cost by various types of depreciation that might be applicable to the property. Yeah, the national appraisal standards around the country favor use of the income method over the cost method for certain income-producing properties. And this is because the capacity of a commercial property to generate a return on the investment is something that investors look at when determining whether or not to invest in property or how much money they want to invest in property. The income method is rarely used to value commercial properties in West Virginia. In fact, up until a couple of years ago, the income module of the state's computer system for valuing property wasn't available to county assessors. My understanding is that that module is now available to county assessors, but I'm not sure to what extent the assessors have received training on use of that particular system. I'm not sure that assessors are gathering the data necessary to use the income module of that particular system. Consequently, assessors are still reluctant to use the income method to value commercial producing properties. On the other hand, there is some question about whether the information that taxpayers provide to the county assessor regarding the income from the property, whether that information is confidential. One of the things that the legislature could consider doing would be to provide rules in Chapter 11, Article 1C, which is the general article that provides for the appraisal of property in the state of West Virginia, that provides for this information to be confidential. Section 14 of that particular article does have confidentiality rules in it, particularly in the case of natural resource properties, but those confidentiality rules don't extend to other types of particularly income information that assessors might have. And one place that the legislature might look for that kind of information is Section 23 of Article 1A of Chapter 11 does have a broader confidentiality rule in it. Now, Article 1A was enacted by the legislature to implement the first statewide reappraisal, or to make the first statewide reappraisal, which was never implemented. And basically, the appraisal functions and who does what all now appears today in this Article 1C that I just mentioned. So, again, something the legislature could do to facilitate use of the income method would be to make sure that or to provide information, language in Article 1C, clarifying that income information provided to county assessors is in fact confidential information. There's a couple other reform ideas that might be considered. For example, the responsibility to appraise income-producing commercial properties might be moved from county assessor's offices and made the duty of the state tax commissioner, who appraises a lot of other property using the income method of valuation. With that, I'll conclude my formal presentation. We're running out of time. See what questions you might have, if any.